Well, hello, everyone, and welcome. This is Cynthia Tomain with Interactive Brokers, and thank you for joining today's webinar with GreenTraderTax.com, as well as Green, Neuschwander, and Manning, LLC as well. I am very pleased to have with us this afternoon Robert Green, Darren Neuschwander, and Adam Manning, who will be monitoring that questions panel in case you do have any questions or comments throughout today's session. So with that, please join me in welcoming today's presenter, Robert Green. Robert, I'm going to go ahead and pass you the controls. Let me make sure I can get you the controls here so that you can there we go. So if you can share your screen, let's get underway. Thanks for joining us, Robert. And here we go. Let's
Thank you, Cynthia. Today we're going to cover tips for traders on preparing 2019 tax returns. February 19th, 2020, it's tax time. Extensions for entities are due March 15th unless you're ready with your return. Your individual return or extension is due April 15th. It's right around the corner. Here's a current picture of me. I'm the host and author of the slides, managing member of GNM, Green, Neuschwander, and Manning. I'm really happy to be joined by my co-managing member, Darren Neuschwander, and our other member, partner in the firm, Adam Manning. They run the tax compliance business in our firm. They do it all day long, every day. They review every return out of the office. They review returns for other CPAs who sign up for that service, or accountants or people who self-prepare and sign up for that service. So these are the guys you want to talk to come tax time. And you can check out their bios in the downloaded slides that you'll see or on our website. Our firm is dedicated to traders, investment managers, and we handle other types of business. Your spouse may be, a Schedule C business or an attorney or something else. We focus on tax compliance. That means preparation and planning. Planning we did before year end. Now it's time to prepare. We also do accounting services to figure out your trading gains and losses in securities. We do consultations. Yes, an entity is good for you. It unlocks more benefits. We set that up for you with our outside attorneys. Lastly, if you have a problem with the IRS or state, and very few of our clients do, we handle the controversy. We fight them to the bitter end to win, and we have an incredible winning record. We work with clients around the U.S., around the world. There are Americans trading throughout the world now. It's an incredible freeing of people's lifestyles. They can move states, countries, and we have a virtual communication process using state-of-the-art systems. Darren's really incredible at those. Today, it's educational information. It's not one-on-one tax advice, but that's your next step. Contact us for the one-on-one tax advice. Every situation is different. Adam's going to talk about those situations with 1099Bs later. It depends on the broker, what you trade. Everyone is a customized situation, so where it's necessary and appropriate, you should communicate with a CPA or a qualified tax advisor or a tax attorney. Now, we're not financial planners. We don't give investment advice. We're not investment managers. When you need help, you go to the people who have a license for the help you need. Now, trader tax is like medicine. If you go to a general practitioner, they're a deer caught in headlights. They just don't understand. It's a bizarre world. Everything is upside down, and our clients know that. Now, we are not affiliated with Interactive Brokers. We do a lot of webinars, but we are a CPA firm. They're a brokerage firm. So today, we're going to talk about this. Several new and revised tax forms, all because of the new tax law, the Tax Cuts and Jobs Act. They made a bunch of changes for last year, and then whoops, it wasn't exactly perfect. They had to make a bunch of changes again for this year. It can be a little confusing. Bottom line, we're going to show you traders, if you're eligible for trader tax status, that's the linchpin to unlock all the benefits, how to maximize business deductions, home office, startup costs, and this critical tax reporting strategies to make it work right. Otherwise, it could be a red flag. Now, there were elections that you may want to make by April 15th or March 15th for this year. Don't lose sight of that. Yes, you're preparing tax returns for 2019. But at the same time, you have to have an eye open to 2020. Maybe you missed the boat in 2019. Catch that boat for 2020, like a 475 election. Now, you get your package of 1099Bs. They start to come out from the brokers around this time of year. If you get interest in a bank, you get a one-page 1099B that says interest, and you put it on your tax return. But it's so much different when you trade securities. There's all this reporting, and it's very confusing, and wash sales and 1256, 6040, 475. It can be a nightmare for some traders, and we help you dissect it all. Some brokers do a better job than others in tax reporting. IB, by the way, is at the top of the list, and we say that without any preferential treatment to IB. They just get it right. Now we're going to talk about learning. And by the way, just because a broker gets it right doesn't mean that it's perfect for you, because we're going to point out there's apples and oranges. The IRS has different rules for brokers than the rules for taxpayers. That makes no sense at all. So we're going to talk about common errors on tax returns for traders that can lead to exams. We're going to talk about tips for filing extensions and paying taxes due April 15th. Now, very quickly before we go into the meat of the content, I was thinking about a couple of points before the webinar. You know, if you have a job in Silicon Valley, you get a W-2, maybe you have some stock options. The W-2 tells you report box X on exactly on your tax return here. Your 1099 interest, report this number here. You open up a TurboTax program, it asks you some questions, you give the answers, you fill in the information, and a lot of you are okay. It's a whole different world for traders. Number one, here's a 1099B, there's 1,000 pages, there's $1 million disallowed wash sale number for the year, there's securities, there's options, there's 1256 contracts, there's ETNs, prepaid forward contracts, precious metals. Tax treatment varies across the board. The broker 1099Bs are based on IRS rules for them, which vary from the rules for you. It can be a nightmare. Now, you want those business deductions? Do you qualify for trader tax status? Who knows those answers? Very few CPAs know how to work with traders. You go to TurboTax, get a professional. By the way, they're pointing out you need a CPA. Ask that CPA, are you a trader? They don't know. So you got to read our content, find out if you qualify. You can claim that after the fact. 475, a highly nuanced area. How do you use that properly? It's everything but simple. It's the opposite of simple. Now, is it worth going through all these issues? You have to. You have to get your reporting right, whether it's good for you or not. But there's gold in these problems. If you figure it out properly, why not get a $15,000, $20,000 deduction for expenses? Why not elect 475 and write off $100,000 trading loss? Why not get a lower 60/40 capital gains rate with 10% off your taxes? So why not get a retirement plan deduction of $63,500 or a health insurance deduction of $20,000? That's some serious money. So let's talk about the revised tax forms. And that's why I give kudos to you. You're here today to learn what you need to know. So they redesigned the 1040. They tried to say it's a postcard, 2 simple forms. They moved everything onto 6 schedules, building block approach. They got rid of the EZ. They said it's simple. It's not simple. It's all the same information. It's just cut and pasted on different forms. So for this year, they backtracked. They got rid of 3 of those 6 schedules. They kept 3, Schedule 1, which is the big one for most of you. So you look on Schedule 1, and you'll see up top they have a question about virtual currency. I'm going to ask Darren about that shortly. The old additions to income, this is like line 8 for other income. That's where you put your Forex. This is your Form 4797 for your 475, your Schedule C. And then your AGI deductions, those are adjustments to income. So a lot of it moved from 1040 to Schedule 1. But look at all these forms. Now, the big thing that hit traders and investors they suspended the itemized deductions on Schedule A. A lot of, not all, but a lot of them are suspended. The certain miscellaneous itemized deductions subject to the 2% floor. Remember, you used to have some, a new computer for your investing, and it was over you paid some investment fees to an investment manager, and you were over your 2% AGI limitation, and you got an itemized deduction. That's gone. All the job expenses, the unreimbursed employee business expenses, the investment expenses, the tax compliance fees and expenses, it's all gone. It's not deductible. The only thing an investor gets is margin interest, investment interest up to the limit of investment income. And there's one other one, stock borrow fees, other itemized deductions. There's a few others on a list, but you're not going to qualify for those. They're very quirky. So if you look at the new Schedule A, they got rid of the miscellaneous deductions. And down here, there's this other itemized deduction. As an investor, you put your stock borrow fees. That's if you're a short seller, you borrow the securities, you pay a fee. If you also pay margin interest, that's up here as investment interest on line 9, limited to investment income. And then you had that SALT limitation, which up to $10,000. So a lot of people don't itemize anymore. They don't file Schedule A anymore. They take the roughly doubled standard deduction, $24,000 and change, married, $12,000 and change, other taxpayers. So investors get hardly anything. Traders get everything. So you want to qualify for trader tax status now more than ever after the new tax law. So I showed you that question on Schedule 1. The IRS added a new question about virtual currency. So this you got to check the box, yes or no. If you say no, and it should be yes, Darren's going to discuss those implications in a second. So before, again, I want to properly introduce Darren and Adam before I now, so I want to show you Darren's bio page. Darren is Managing Member, Chief of Tax Compliance, co-managing member of the firm, best practices, runs the accounting practice, management, compliance, professionals training. Darren's on the AICPA task force for virtual currency. He's written a lot of incredible publications, detailed stuff in the profession, and he's highly respected with CPAs around the country and by the AICPA task force for which he works. And then also Adam Manning also is a member of the firm, a partner in the firm, also in running tax compliance along with Darren. So check these guys out. They're incredible. Let me go back to where we were about the virtual currency question. So now let me get my partners involved. Darren, tell us about that question, why the IRS added it this year, what's going on with virtual currency, and what you're doing with the AICPA task force.
Thanks, Bob. Appreciate the opportunity to be here today with you guys. I will caution you for the 2019 return. With a Schedule 1, you will see a new question, and that's the question you see on the slide. The IRS is basically kind of fishing to see who is and who is not reporting virtual currency. And I will caution you about just skipping over this question. You need to take it very, very seriously. If you did any type of transactions in virtual currency, you really need to answer this question. There's been some controversy as far as, well, what if I don't have to file a Schedule 1? Do I still need to answer this question? Some readings you will see, no, you don't, but others you will see, yes, you do. My recommendation is if you did any type of virtual currency, if you basically just purchased it and held it in a wallet, or if you transferred from one wallet to the next, you probably want to answer this question, yes. Now, with my direct involvement with the AICPA, we are asking the IRS to be a little bit more specific with this question because there's a lot of uncertainty. If you read the instructions to the 1040, if someone just buys virtual currency, well, in the instructions to the 1040, that doesn't necessarily mean you have to answer this question. Yes, by answering it yes. But you see other interpretations saying, well, that's still receiving virtual currency. So it's the first year for this question to be on the 1040, and I would heed with a little caution. If you received any type of virtual currency, answer this question yes. Now, there's even been more controversy with this. Is what if you have children that live in your house and you claim them as your dependent? And a lot of kids, teenagers, younger kids are playing Fortnite, and a lot of those kids actually buy what's called V-Bucks. Well, the IRS is addressing a lot of these questions right now on their website on what's called frequently asked questions, FAQs. That's not authoritative information, but it is kind of giving us a direction of where the IRS is going with this. Last week, the IRS put on that page that V-Bucks was a virtual currency. Well, just this morning, they changed it and took V-Bucks off of it. So that's the reason why the AICPA is directly getting involved with this, because FAQs are not authoritative, and the IRS can't put something on their website one day and then basically a week later take it back off. That is not giving you, the taxpayer, authoritative information on how they should handle these transactions. So we wrote a letter. We've actually written 2 comment letters to the IRS. I personally was involved with a discussion in Washington, D.C. with members of with the government and also with the IRS, talking about issues that we're struggling with virtual currency. The AICPA is about to release a 3rd comment letter, and you can, if you are interested, you can just Google AICPA comment letters, and you can see all of our comment letters and the questions that we're addressing on that. So virtual currency is something that's here. It's not going anywhere, but there's a lot of people that have not been reporting it. And if you're involved in it, make sure you're properly reporting it, and just stay attuned to what's really going on. And if we see that there's something that is relevant that needs to be addressed with taxpayers as a whole, we may address that on a blog on our website. So again, just a word of caution, a new question for 2019. Do not skip over it. If you did anything in virtual currency, please take that very serious this year.
Now, Darren, is it still that you don't have to report virtual currency on an FBAR for foreign bank account report, or are people wise to put it on the FBAR if they have a foreign coin exchange?
At this point, we have been told that you're not required to report it on an FBAR, but if you would like to heed on the side of being more conservative and making sure that the Treasury doesn't change their mind, it doesn't necessarily hurt you from reporting that on an FBAR, but at this point, you're not required to. Now, that could change very soon, and if it is changed, I'm sure that we'll inform our clients of that as it comes out.
Thanks, Darren. Let's go to the next screen now. This is the big area for traders, deducting business expenses. Everything under the sun that relates to your trading business. Startup costs, you go back 6 months to get a bunch of those expenses. Home office, you got that exclusive use area. You want to write off a big portion of your home, you want that as well. It can be $5,000, $10,000, $15,000, $20,000 of deductions. Are you eligible for trader tax status? Many traders don't claim it when they're entitled to, and they could after the fact. Or others, they claim it, but they really shouldn't. They really don't qualify, and they're pushing the envelope. Now remember, the IRS does not require an election for trader tax status, but they do for 475. Now, we get mix-ups on this all the time. Darren told me some horror stories this morning as we were prepping the webinar. Darren, tell me about that client that contacted us recently. They thought they qualified for TTS. They read all our content, but then what did they want to do with their trading losses?
It was an unfortunate circumstance. The individual was not an existing client that came to us and had heard about trader tax status, was very gung-ho to claim it. And once we got into the details, I understood why the client wanted to claim it. She had a trading loss of $250,000 for the year, and she wanted to be able to report that loss in full. And she was trading stocks. And unfortunately, when I asked her the question, well, did you elect mark-to-market accounting timely for 2019? She said, no, I want to file as a trader. I said, well, you can file as a trader, but you had to have elected mark-to-market accounting timely for 19. She said she didn't do that. And unfortunately, I had to tell her that because she missed that election process for 2019, which it's way too late to go back in time to do that, her $250,000 loss that she had from trading stock would not be fully deductible, and it's going to be a capital loss, and she would only be able to deduct $3,000 of it in the current year, and the rest, the $297,000, is carried over to 2020. I mean, she was destroyed. I mean, that really hurt her planning, but unfortunately, she just missed out on it.
And Darren, she was doing a new client evaluation with us for our tax compliance service, which is very popular. We accept new clients that have trader tax status. They don't have to have 475, but they need trader tax status. And she felt she had it, so she could qualify for the service, but she had a misconception. And you flush that out in the new client evaluation, which we don't charge for, because you're looking to make sure the client's a good fit, and you don't want them to have expectations that wouldn't be fulfilled.
Absolutely. I mean, we want to take on new clients to where we can add value back for you engaging us. And it was just unfortunate for her circumstance that she did not have a lot of trading related expenses. Her main thing was filing as a trader to be able to deduct that loss. But because she could not deduct that loss because she missed the election, the immediate value was not there, and we wished each other the best. And if there was some planning opportunity we could do for 2020, she was going to sign up for a consultation. So that's what we do, is we're always trying to be able to add back value to you as our client.
Now, this one got through the cracks, Darren, because normally you or I do a consultation, a 45-minute consultation to see if they qualify for TTS. Did they elect 475 or not? We square away all the things so that when you do the new client evaluation, there aren't surprises like that. So we do suggest the consult first. Now, the first benefit of TTS is business expenses. That's not chump change. That can really add up for a lot of people. You want to see if you qualify. So you click on the blog post, you come over to the website, and you go through the factors. And then you want more detail, you go to the guide, chapter 1, where we go through the whole thing. That's the first thing that every one of you should be doing is, do you qualify for TTS? It opens up the whole world of benefits. Again, first are the business expenses that you deduct on a Schedule C. So after this webinar, you say, Bob, wait a second. I read the blog post. I qualify. I had 6 trades a day, 4 days a week, over 15 a week, over 75% frequency, the 4 days a week, holding periods under a month. I'm good on the big 3. I'm good on all the other factors. Let's add a Schedule C. What can I deduct? Well, you're going to deduct the business expenses, the startup cost, the home office. What do those include? We're going to go through that next. What you're not going to do is put trading gains and losses on Schedule C Part 1, only putting expenses on. Why? Because your trading gains and losses go on the other forms. We're going to cover the expenses in a minute. But first I want to point out that your trading gains and losses go on a whole bunch of other forms with all sorts of divergent rules. There's all sorts of financial products to trade with a bevy of different rules. So it's Form 8949, that cost basis reporting form for securities, with all those draconian wash sale loss adjustments. You got to report each trade separately. This is when you consider the trade log software to download your trades from the brokers across all your accounts. And it all goes on to 8949, which then works over to Schedule D. You don't enter things directly on Schedule D. It's on other forms, and it moves over to Schedule D. Now, what if you trade 1256 contracts, futures? Those go on Form 6781 with summary reporting, with a great one-page simple 1099B, aggregate profit or loss with mark-to-market. It's nice and easy. Not only do you get lower tax rates, your life is made much easier. What if you trade Forex in the interbank market? That's Schedule 1 other income. That doesn't go on 6781. That doesn't go on 8949. It goes on Schedule 1, ordinary gain or loss, summary reporting. You use the P&L report from the broker. There is no 1099-B. Now, lastly, if you make a capital gains election for Forex, it's a little different. We're not going to get into too much Forex stuff today. Now, brokerage commissions can add up in the past. Now, as the brokers chase lower commissions, free commissions in some cases with light software, which a lot of you may not be using, commissions don't go as a separately stated expense. They're not on Schedule A. They're not on Schedule C. They're part of your net trading gain or loss. The broker takes it out of the sale proceeds and adds it to the cost purchase. So if you have a capital loss limitation, you're being disenfranchised from some of your brokerage commissions. On the other hand, if you have capital gains and you're an investor, you're getting every dollar of deduction. You're not getting stuck with an investment fee or expense suspension. Back to the Schedule C, and I'm going to come back to Darren and Adam on this a little bit too. So first up, the tangible personal property, $2,500 an item. What's that, Darren? Darren may be answering questions, or Adam, you want to jump in on that? They may be answering questions.
I can answer that, Bob. That's where basically, if you purchase a new computer and you qualify for TTS, I mean, if the computer is under $2,500, you can write that off as an expense in the full year, as opposed to having to capitalize that and depreciate that. So basically, if you can keep each of your purchases for equipment $2,500 or less, then we'll be able to write those off in full in the year of purchase if you qualify for TTS.
Now, Darren, if they get a really powerful computer for $5,000, they're not out of luck. They can still use a 100% depreciation method, right? What's the next item on the list here?
Possibly we can write that off under Section 179 if you have trading profit or if you have other sources of income, such as W-2 income, we may be able to write that off. But for Section 179 deduction, to be able to write that off, we have to have incomes. So if you have a trading loss for the year and no other sources of income, we may not be able to write it off in full under Section 179. But
so what can you do? What is bonus depreciation? Regular depreciation, is that lucrative?
Depreciation, we don't necessarily have to have an income for that, so there's an opportunity to write that off, which right now that's potentially up 100% as well. We can deduct that. So the rules for depreciation for someone trading, which doesn't have a large amount of capital, as opposed to someone that's going out in construction and buying large bulldozers or anything like that. Most of the time, a trader should potentially be able to write off most of their trading related expenses, such as hardware and et cetera, in the year of actual purchase.
Now, Darren, every so often we get the client says, I want to buy a luxury vehicle. I heard this great accelerated depreciation, but we poo-poo the auto. What's our position on autos for traders?
Well, the reason for that is you're a trader. Most traders trade from their home office, and it is hard to substantiate the idea of deducting a vehicle, especially writing off a full year. You buy a vehicle and say it's used 100% for business. That may be, but that's a little of a stretch when most of the time your business is being conducted from your home. It's not that you really need that vehicle for trading. It's not like you're having to go out and visit customers or clients at another location. So I really frown on that when someone's trying to write off a vehicle for trading.
Now, next we talk about amortization, which is expensing of startup costs, Section 195, organization costs, Section 248. That's like when they pay us for an entity formation or software. We talk about that, Darren, because we get a lot of clients from these trading schools, and I'll get Adam in on this too now. We get a lot of clients, Adam, from trading schools. They pay $15,000, $25,000, $40,000. They want to learn how to trade before they start doing live trading. They're paper trading. They haven't started TTS. Paper trading doesn't count. You got to make the live trades. So, on the seminar circuit, someone may come to them and say, hey, use a dual entity scheme, a C Corp will go back. We say no to all that because that's an investment company. You can't deduct anything in the C Corp. But we do allow this concept of the startup costs. How does that work, Adam? What are we getting out? And is that really valuable to a lot of our clients because they have costs before they start?
Yes, the startup cost does allow them to actually look back. We usually use 6 months to see what expenses they had or incurred in investigating this business and getting it set up and up and running. So if you had those training costs ahead of when you actually formed your entity or got into your trading, then you could actually take those and deduct up to $5,000 in the first year and then amortize the remaining amount over 15 years.
Now, would that mean like if they came off of Wall Street and they had a Bloomberg terminal, they had some expensive data, software subscriptions, a lot of those soft costs, they sounds like they could capitalize under Section 195, whereas the hardware costs, they could contribute to the business and get depreciation on. So they're two different boxes. But I mean, is there like a reasonable amount on that? I think I have a slide for that later on. We'll come back to that, Adam, with some other points on the 195. But one big one is education expenses. They pay for it, they take the classes before they start trading. And pre-business education is not deductible. But we find a way to squeeze it into the 195. It sounds like what you were saying, Adam, is that's what people use 195 a lot for. Is it the education?
That's right. I'm sorry, I lost the audio there for a second. Yeah, that's correct. Basically, the education is usually the largest thing we see that gets you to that 5,000 startup limit, or the amount you can expense in that first year.
And then the rest is over 15 years straight line.
That's right.
So they're still getting it. Now, what if they exit the business after 3 or 4 years? Can they write off the balance of that or no?
That's correct. Yeah, once you exit the business, the remaining amount is expense in that year.
So it sounds like when someone gets started in the trading business, I know when, let's say I do an entity formation, Adam, I pass them the baton to you after 30 days that everything is executed right, and then you give them a bunch of resources. But a lot of it is to capture onto the balance sheet of the entity all this equipment, all this soft costs, all this potential expenses that could have been capitalized for expensing, because we're trying to maximize expensing. And it's great that you work with the clients to flush that out. Now, back to you, Darren. You bought the computer, let's say 9 months ago. It's not the 6-month rule for 195. You spent $3,000 for the computer, but maybe it's valued at $2,000 or $1,500 by the time you get TTS. How do you handle that? You haven't depreciated it yet?
Oh, we have to look at the 6-month period and then really look at what the computer is worth at the time that you actively started trading. So there's a useful life to a piece of hardware, and a computer is usually 5 years. So, but if it's a 3-month period, I mean, I can still say there's not much use for that computer. So we'll be able to potentially include that in startup expenses at the original purchase price.
So it sounds like a lot of judgment, and that's good for us to make rather than AI systems to make. There's a lot of judgment involved that we take into, I think, account numbers and a lot of factors. Now, there's a whole long list of expenses: publications, market data, professional services, accounting, law, legal, other, chat rooms, mentors, coaches, supplies, phone, travel. Notice entertainment is gone for the new tax law. Seminars. You come to New York to see me in early March at the Traders Expo, and a lot of other people too. You're not coming just for me, but I'm on your list. Or you went to see Adam in Las Vegas, or you went to see Darren in Chicago for the Traders Expo. If you're a TTS trader, when you go, you're getting a business write-off for your trip, not the personal portion, not your spouse if it's personal, but you're getting write-offs, assistants, consultants. There's a whole bunch of it. But one of the biggest ones of all is the home office. That's a big deduction for traders. I'm going to talk more about home office shortly and get the guys involved on that one. Margin interest, you don't have an investment interest limitation. It's all deductible. Your borrow fees. Darren, don't we have some big short seller clients? How much can the borrow fees total up to?
Several $100,000 with some of these clients. That's basically all they do is short sell. So those fees can dramatically ratchet up very quickly.
I mean, yes, they can do an itemized deduction for it, but they would much rather have a business deduction for it. In terms of lowering AGI and all the things that pivot off of AGI, the QBI and all that kind of stuff. Also, internal use software, if you self-create an automated trading system and you have a lot of cloud computing and co-location expenses, you want to write these things off. Now, if you're using an automated trading service with an outside vendor, then you don't have trader tax status on that and it's not deductible at all. Now, back to the home office on Form 8829. And I know there's a lot of nuances with that, Darren. I know we used to try to, move that over to Schedule C and do a transfer strategy, but then you said, Bob, it's a little easier. We can point directly to the trading gains. This is one of the most significant deductions for traders. Now, almost every one of our clients has a home office. They may also trade from their employment office. They usually trade from morning at home. At night, they do administration work. They have a home office. Then it comes down to, do they have exclusive use? And usually they tell me they do in the consultation. Adam and Darren, you first. Most of our tax compliance clients, by the time they finish the job with you and our team, do they pass muster on exclusive use tests? And what are some of the nuances with that?
Well, yes, most of them do. The only time we really have any issue is, for instance, with someone that lives in a major city like New York City, which is living in studio apartments. Those are a little bit difficult at times when you don't have a totally separated room. But, if you've isolated an area out of it, I mean, it's possible that you could still qualify. I mean, some things to add to this. I mean, you're talking about, with a home office, there's really two reasons that I recommend it. One is it helps if you're trying to say that you're in the business of trading. It actually helps support the fact that you are taking this seriously. You have an exclusive area. And I'll give you an example why. We had a taxpayer in California that was being audited by the state of California, and they were trying to determine whether that individual qualified as a trader. The actual agent made a visit to the home after that was part of their final thing to sign off on, saying that this person qualified. They actually wanted to make a visit to see the person's home office. We sent pictures in, but they wanted to actually physically see if that's really what it was. That agent walked into that individual's home office. They saw the multiple monitors. They saw all of their research, etc. And the agent signed off on that because they could see that this person was serious about their business of trading. So that helps tremendously. The other reason is when you claim the home office deduction, you got to think of expenses that you normally would not get to deduct anywhere else on your tax return. Think about your power, your home insurance, a portion of your pest control, a portion of your lawn service, etc. Those are all items that go along with maintaining your home. Well, those expenses are normally personal, non-deductible expenses. You get no tax deduction for that. But if you qualify as a trader, you potentially take those personal, non-deductible expenses, and now you change a portion of that based on the percentage of your home office to your total home square footage, and turn those into deductible business expenses. So that's another key why claiming a home office deduction is so valuable. You're actually taking expenses that you're already incurring and turning them into a tax deduction.
Now, Darren, the mortgage, interest, and real estate tax portions of home office don't require income, but otherwise the deduction requires income from trading gains. And if you don't pass muster on that, you get a carryover to the next year. So our clients carry it over and they need TTS in the next year. But the home office deduction might also help navigate around the SALT limitation. So talk about that a little bit.
Yeah, that's another key where you talk about the carryover. Some people say, well, you know what, I had a trading loss for the year. I don't want to claim the home office this year. And I was like, well, hold up. It's a carryover. So just because you don't want to claim it this year, let's still report it. We won't get a current year tax deduction for it, but it carries over so that the year that you're profitable, you'll get the current year home office deduction and what we carried over. So there's still some some value by claiming it, even in a year of loss. And to go into the Schedule A limitations, the SALT limitation, and now some potential with the mortgage interest when you have excess mortgage over the new limitations. There's a capability, if you do actually itemize, or even if you take the standard deduction now, you still potentially can still get some of the actual real estate and the mortgage interest. So you can kind of have your cake and eat it too. You can take the much higher standard deduction and potentially still be able to take your mortgage interest and a real estate tax, a portion of that that's allocated to the home office, take that as a business expense. So even though you're saying, well, I don't itemize anymore, you still potentially can get a deduction for that if you claim a home office. So that's kind of having your best of both worlds.
Now, Darren, the Schedule C for the trader has expenses only, so there's no income, denying a lot of the deduction, but they have trading gains on, let's say, 89.49 Schedule D or 47.97. How do you jigger the return to unlock the deduction?
Well, what we can do is actually transfer a portion of the trading gains from Form 8949 or from Form 4797 to Schedule C, just enough to basically offset all of the expenses, including the home office. And we've been doing this since 1997 with that one transfer. And the only reason we transfer it is basically to match up the expenses. And we've never had the IRS question it. It's always been fine for doing that, because we're not necessarily changing any of the character of the gain or loss. We're not transferring long-term capital gains to Schedule C. We're transferring short-term, because you're a trader. You should have short-term capital gains. So that way it matches up and it frees it up. And then with all of our trader tax returns, we include footnotes with our returns. And those footnotes are typically 3 to 4 pages long, where we explain trader tax status, explain that they're electing mark-to-market accounting. And in a case where we actually do the transfer, there's a paragraph that we add to the tax return that explains to the IRS and the state, if you're filing a state return, why we're doing the transfer. So all of that's transparent right on the face of the return.
And you say also on the 8829 that you can point to the gains on those other forms without the transfer?
There is a line item that you can put directly on the 8829 where it shows other gain and loss, and it will pull from Schedule D, which your 8949 goes to Schedule D, or it can pull from Form 4797. Absolutely.
Do you like to explain that in the footnote too? So you're pointing to business gains rather than investment gains?
Right. That's all addressed. So that's a strategy we have used again for several years now, and it has been very successful.
Great. Adam, on the startup costs, they go back 6 months. So let's say they spend $15,000 with the trading school. They can write off the first $5,000, the rest over 15 years. That's pretty much what you were telling us before. That sounds like it's better than nothing, right?
Correct. Yes. And like you said, if you were to exit the business ahead of schedule, then you would just take the remaining amounts of those that was being amortized.
Now, I know in our tax guide, Adam, I talk about the cash method versus the accrual method. A lot of people spend $15,000 with the trading school, but it comes with lifetime learning, and they only take a fraction of the courses before they start to have TTS. So if they use the accrual method, they may be able to, instead of capitalizing 15 and writing off 5, some of that is deferred with the accrual method, and they get a much better result. Have you been doing that on the tax returns the way we talk about it in the guide for some clients?
We haven't seen it as much, but yes, that is an option out there where it would just be, I guess, prepaid educational expense, and you would take the portion and deduct it when in the year that you actually take the classes.
So we can even do better than 195 in some cases when someone has a lot to capitalize.
Exactly.
Darren, I'm glad you mentioned the footnote. I've used footnotes throughout my career. I remember my first boss said, "Why give information to the IRS?" And my answer was, they have obvious questions that they need answers to nip it in the bud. Why wait for an audit? If you know something is begging a question, And if you have expenses only on a Schedule C, what kind of business is that with zero revenue? You have to explain the TTS law, that the income's on other forms, how you qualify. We put all that. Like, for example, Darren, when I do a consult, I go through all the factors. Do you recap some of that in the footnote?
Absolutely. I mean, we're basically going through, and we're more or less explaining for every one of our trader clients in his footnotes what trader tax status is, why this person qualifies for it. Have they elected 475F? Where is everything reported? Where's the expenses are on Schedule C, the income's on Form 8949, 4797, 6781. So we're more or less imagining that we're sitting across the table from an IRS agent that absolutely has nothing in experience related to trader tax status, and what would you give that person? And that's what our footnotes are basically set up for, is we're explaining to them what trader tax status is and why this particular taxpayer qualifies for it.
And when we tie the forms together, we say, yeah, okay, there's $25,000 of expenses on Schedule C, but this client made $200,000 on Form 4797. It's a very profitable business. If you're going to send them anything, send them a thank you note for paying taxes. That's one of my jokes. Okay, so let's get into a little discussion with our G&M partners, Darren and Adam. So, Darren, I know you've given us some tips already, but what kind of other tips can you think of off the top of your head for traders to maximize deductions on Schedule C? What's a typical amount of expenses? I mean, if someone comes in with $300,000, like some of those tax court cases, and it's not borrow fees, you're probably a little suspicious.
Yeah, that's a little excessive for a trader, but more or less, especially when I'm sitting down with someone new, that is, when I ask them the questions, what do you have as far as trading related expenses? And sometimes I'll get the answer, well, I really don't have any. And then I stop and I say, well, let's go through what you do in a typical day. What are you using? Well, I'm using my computer. Okay, when did you buy your computer? This year. That's an expense. Your internet connection. How much of that do you use probably for trading? Probably 75%. Okay, that's a business expense. Do you have CNBC? You're watching that while you're trading? Yeah. Okay. You have a TV you bought just for your trading room? Yes, that's business expense. Your cable bill, how much of the, allocate how much time you're watching CNBC? Well, that's pretty much over half of my day. Well, there's a percentage of the cable bill. So it's more or less just going through and evaluating what you're doing, what you're purchasing, and those are potential expenses you're missing out on. And that's different for every taxpayer. Some people are able to trade from their office, their other W-2 jobs. Somehow they're able to do both simultaneously. That person may not have as much as expenses as opposed to someone that has a dedicated home office. And I've had a question on the board talking about, well, can I still claim the home office if I also have a W-2 job and trade from there? Well, if you do a majority of your research, you're analyzing what you're doing from your home office, there's nothing to say that you can't still have your home office even though you trade and maybe close out some trades at your W-2 job. So it's not just a set standard. Everyone's going to have $10,000 of trading expenses. It's an individual circumstance. So, really, when you sign up as a client for our firm, we send you an Excel organizer. And what we do in that is we break out all the typical expense categories that a trader has. And a lot of times that'll actually trigger something, I've never thought about that as an expense. So that's a value that we give back to our clients, showing some expense categories that maybe they haven't considered.
Great. And Adam, how should traders keep track of their expenses? I mean, you don't want them to give you a shoebox of receipts.
Of course not, but it's also, as Darren said, it's an individualized kind of situation. Whatever your best method is to organize those and get them to us. Again, we have these organizers available that will send clients. We ask them to fill that out. So whatever they can use throughout the year to assist them to fill out that organizer, that's what we're looking for.
Now, Do they need an accounting program like QuickBooks or Quicken or some app, or they use Excel worksheets? I mean, what do most people do, and what do they find to be most effective?
Well, we see some clients that use QuickBooks or different programs to track their expenses throughout the year, and that's fine. And often I'll caution clients on QuickBooks or let them know early on that it's not required. And if you do use it, we try to make sure that we're simply just using it to track our expenses, and we leave the brokerage account out, because we find that oftentimes it's just too confusing for the client to keep up with the brokerage account and the QuickBooks, and it creates kind of a mess that needs to be fixed. It takes more time and effort than it needs to, and their time or our time is their money, so it keeps costs down if we just use that to track the expenses. Or they could just use QuickBooks to assist them to fill out the organizer, which really actually helps us the most, because the organizer is using the same descriptions that we use on the tax return.
So I think you answered the last question. What resources do we provide to our clients? You mentioned an organizer. Are there other resources like worksheets? Yes.
We try to provide, as Bob mentioned, we do assist with some entity formations, and he passes them along to me. And at that point, I usually send them the organizer so they can just see what we're going to give them in the coming year. And I also give them an Excel expense tracker, which has the monthly tabs at the bottom for each month. And then they can list out what they buy and then scroll over to whatever category goes in and list the amount. And if they do that throughout the year, then they're done with their expense portion of their tax return. So when I see them the next year and ask them for their expenses, if they've maintained that expense tracker, then I have all I need for the expense side of the tax return. Now we just have to get the trade accounting done and the 1099.
I find that for the home office, the expenses can be so many different types, like Darren mentioned, that seem personal. So I myself like an accounting program, but everybody's different. I like that about the advice you always give, Adam. You always seem to customize things for people's situation to what works best for them.
Everyone's different, so you just got to find the right way to work with what they understand, I guess, so to speak, to make it as easy as possible on the client.
Right. I mean, I like the accounting program. I'm an accountant. Makes sense. Section 475, just a couple of numbers, but it's a claim to fame for GreenTraderTax. Congress passed the law in 1998 saying you don't have to just be a dealer to have ordinary gain or loss. You can be a trader who was going into the tech wreck, being an accountant, looking at the downside as well as the upside. I went out on the internet and said, you got to elect this. It's free. It's tax loss insurance. When the tech wreck happens, don't you want to write off your losses 100% and not have a capital loss limitation? It was our claim to fame, and we've been riding that wave ever since. So we talk about it a lot. Now it's not just tax loss insurance, but it gives you a qualified business income deduction if you're profitable. It's not just for the losing trader, it's also for the profitable trader. Unless you make a boatload of money, then you get phased out of the QBI deduction. So the chief tax benefit over the years was deducting your losses without limit. Only TTS traders can use 475, not investors. So remember we talked about before, TTS is one thing, 475 is another. TTS is like undergraduate school. You claim your diploma, then you apply to grad school, 475. Not everybody goes to grad school. You can't go to grad school unless you graduate undergraduate school. So they're tied together, but they're entirely separate. Why would a securities trader want 475? Well, they want to be exempt from draconian wash sale loss rules. You day trade symbol X. You take a loss on 12/29. You buy it back on January 3rd. You can't deduct the loss in 2019. The loss is deferred until 2020. Traders hate wash sale losses. They could be hundreds of thousands of dollars. It's phantom income. It's a tax bill. The IRS is asking you to pay taxes and not allowing you to deduct your losses until the next year when you could have a capital loss limitation. It's tragic. We've seen so many tragic outcomes for wash sale loss scenarios. What's your ticket out of it? 475. Now, let's say you have a big loss. There's that 3,000 capital loss limitation. They've never indexed that for inflation. I know that the current administration wants some new investor tax rules, new deductions. Why not increase the capital loss limitation? It's never been indexed for inflation. You want ordinary losses, business loss to offset your wages, offset your spouse's income? 475 is your ticket. Now, do you want 475 on futures? No. You want to retain the lower 60-40 capital gains rates. Do you want 475 on your investments in, FANG stocks that you've been buying and holding for a couple of years, separate from your trading assets? No. You want to have deferred long-term capital gains. You can have your cake and eat it too. You can have all these things. There's so many miscommunications on 475. Now, the new tax law did rock the boat. They did take away some of this have your cake and eat it too stuff. One thing they did that really upset Darren early on, and Darren was one of the leaders working with the AICPA to get fixed, was they repealed the NOL carryback. Darren, didn't we used to file tax returns with some like $1 million NOLs or multi-million-dollar NOLs and get incredible refunds?
Yes, we did. I mean, this was a really a substantial blow to a trader because some traders being able to, in the year that they had a substantial loss and we were able to take those losses back to offset it against years that they had income, being able to do that was a way to refund their trading capital. And the fact that we're no longer allowed to take those NOLs back and can only carry it forward really hurts the trader that just had a real down year, because we're not going to be able to recoup that trading capital. It's really going to be on the trader, him or herself. So I was really disappointed to see this, and it hopefully it'll be reconsidered in the future. But at this point, it's something that a trader needs to be cognizant of, that's not there. And I'll add to this, we're talking about 475F, and that's having to do with securities. And when I'm talking to someone that's trading, you may want to consider trading in futures, section 1256, because even though the net operating losses, you cannot carry that back under 475. If you have trading section 1256 and you had section 1256 gains in any of the 3 previous years, you can take a net section 1256 loss back. So that's still there. So a lot of traders that still want a kind of an insurance, that's an option to consider.
And we have a slide on that a little later on. I was thinking that they just overlooked that, Darren, when they went through changing the whole, what they wanted to do with the new tax law. Otherwise, maybe commodities traders succeeded again. There's also the excess business loss limitation. And if it's an EBL, the excess business loss, then it becomes an NOL. So they kind of hurt you with the NOLs, and now they push more things into NOL treatment. So maybe you had a 475 loss of $500,000 and you wanted to soak it up with a Roth IRA conversion. Well, you didn't realize that there was an EBL limitation. What is a good thing is you can soak it up with part of EBL is wages. So there are some nuances to the EBL limitation. But if you have $1 million loss, you're going to end up probably with some NOL. And then you can only apply it to 80% of the income in the next years. It is unlimited. They got rid of the 20-year carry forward, so you all going to use it. I don't mind that 80% limit so much, Darren, because then the other 20% is in lower tax brackets, and you get the standard deduction. You agree on that?
I do agree. I apologize. I was trying to address some of these questions.
Oh, that's great that you're doing that. By the way, everybody, get those questions on the board. Keep them kind of general, not too specific. For specific, real specific questions, we want to give you one-on-one advice in the consult process. But get your questions up. Darren will give you a kind of a general answer. And he'll talk about some of the great questions and answers later on for the benefit of everybody. So 475 has been tax loss insurance. Not as great as it used to be with the NOL carryback on. And by the way, that's where the audits of traders used to come. Used to say, hey, I want a refund on a $500,000 NOL carryback. There's like a customer service division of the IRS saying, what? They want their money back? Let's take a look. Now that they don't take a look anymore on the carryback, I think things sail through a lot more. That's one of the silver linings. Now, if you're profitable, you might also get a benefit from 475. Now, maybe you don't have 475 in 2019, but this is useful to you should you elect it for 2020. That election's due March 15th for entities and April 15th for individuals. So pay attention. Don't just turn your ears off on this section. We've got a lot of content to cover, so stay with us.
Bob, if I can interject before we keep going on 475, a good question that came up. Can you elect 475 for securities and not for futures and commodities? Can you address that?
Yes, we're going to, on this next slide here, and I did already mention that you were elected for securities only. Now, 475 is you can elect it on securities and or commodities. Commodities include 1256 contracts. We recommend that in general that you elect it on securities only, and you put that in the election statement so that you retain the lower 60/40 capital gains rates on futures, and you retain that futures carryback option against futures gains that Darren was talking about. So we cover that in the election procedures. So you can have your cake and eat it too. So let's talk about this QBI deduction. This is something that our firm fought for the rights of traders to get. And it was very difficult to do it. We had to get on the phone with the chief counsel's office, deal with a lot of tax writers. It was pretty difficult going. We have a whole story about this on our website in the blog post. But the long and short of it is that there's this new QBI pass-through deduction. C Corp's got a much lower tax rate. What about pass-through businesses? What do they get? Nothing or something? Well, they had to give them something. They gave them the qualified business income deduction, like the old depletion allowance. What is it? You make $100,000, you get a $20,000 deduction if you go through all these hoops and all these haircuts and limitations and everything else. Bottom line is you're not spending $20,000, but they're letting you write off $20,000. Who wouldn't want that deduction? There's all sorts of limitations. We're not doing a QBI seminar today, but the bottom line is if you have TTS, you have QBI expense. That's not so great. If you have TTS, you can elect 475. And if you have 475 income, you can get a QBI deduction. If you have capital gains income, you don't get a QBI deduction. Trading is a service business. I go through the QBI a little more later. Let's get back to the election procedures. This is so important because people miss the boat. You go to your accountant on April 10th. You said, I just watched the recording. I just read the Neuschwander Manning content, GreenTraderTax content. I want to file as a trader. You don't expect your local accountant to figure this out during tax season in the last few days of the year. They're probably going to poo-poo it, tell you you can claim it later on. You're going to miss the boat. Existing taxpayer individuals that qualify for TTS and want 475 must file a 2020 475 election statement with their 2019 tax return or extension with the IRS by April 15, 2020. And now it's too late to do it for 2019. You had to do it by April 15, 2019. The IRS doesn't want hindsight. They want you to do this in advance. They don't want people cheating. They make you sign, or they want an affidavit statement on the 3115 later. There's no playing games on this, folks. It's you either do it or you don't. And we flush you out on it. And we do not play games. We would never sacrifice our integrity as a firm, our morals, our ethics, and our credibility with the IRS over this issue. Now, existing partnerships and S-Corps, Their 19 tax return is due March 15th, so that's when the election is due. Now, if you set up a new entity with us this summer, it's a new taxpayer, it can file an internal resolution election for 475, but they must do it within 75 days of inception. And we don't play games on that either. There's the honor code. And again, our firm is so highly respected because there's no fooling around. We call the balls and strikes on trader tax status the way we see it. That's for the benefit of you and all our other trader clients. Now, if you filed a 475 election for 2019 by April 15th, great. You're in luck, but don't forget that you need to complete the process. It's a two-step process. You have to file a Form 3115, a change of accounting method, with your 2019 tax return. File your extension by April 15th. You have until the due date of the return. Now, Darren, the Form 3115, it's 8 pages, all sorts of questions, very intimidating, but really it's not that complicated if you know what to do. If you don't have a 481A adjustment, we don't hand those out. People need to use our service on that. What could people botch on that filing?
A lot of things. The 3115 is, it's very intimidating. There's a lot of information on that form that some of it is not even relevant for the filing. And that's a form that you don't want to botch. A copy of that 3115 has to be attached to your tax return for the year you elected it. So if you elected 475 for 2019 timely, so now we're filing your 2019 tax return. So a copy of the 3115 has to be attached to that. Then a separate copy of the 3115 has to be sent to the IRS directly to a specific office. And that office, that's all they do is review 3115s day in and day out. So someone is actually going to physically review that 3115. It's not computer review, it's a physical person. So you want to make sure you have that one right, because that, going back with that, then you're running into a whole issue of making sure that your mark-to-market accounting election was truly done properly.
Now, we got a new client there, and they say they've been using 475 for years, and we asked them for their 3115 filing. They don't have it. We start getting suspicious, right?
Absolutely, because there's, as you are alluding to here with all the procedures, it's electing it is step one. I mean, then you have 2 other steps. You have to calculate a 481 adjustment, which that's basically converting you from cash basis, that's capital gain and loss treatment, to ordinary gain and loss treatment. Then you got to file the 3115. You got, that's basically perfecting the mark-to-market election. So you got to do all of those steps, and if you don't do those properly, the IRS has all rights to potentially question your overall eligibility to use 475.
Now, accountants are not used to 2 steps. They filed the 3115 thinking it takes care of everything. They're 1 year early, and they didn't make the election statement, and that's a botch.
That's a botch, and it's very confusing to the IRS because you're filing 3115 a whole year early, and you haven't sent a separate copy in to the IRS. So knowing how to do this in the proper steps is really what's going to get you to where you don't have any potential issues with the IRS questioning anything.
Once you know what to do, it's not that big a deal, and it's so important for 75, it's worthwhile. Now, Darren, what are some of the accounting challenges in converting from the cash method, we call it the realization method when you sell something, converting to 475, which is mark-to-market reporting?
Well, again, that's called the 481 adjustment. That's basically step 2 in perfecting the mark-to-market election. Is anytime you go from cash to mark-to-market, in that first year, we have to look at your open positions and, in essence, get you onto the mark-to-market basis. And that's a calculation. We're just looking at the value of the positions at the end of the year. So for 2019, we'll be looking at everything you hold open at December 31st, 2019, seeing what the ending market value is, and then adjusting the difference between your original cost basis and that value That's what the 481 adjustment is. The challenges that we have is when you're actually actively trading and you had substantial wash sales.
Here's a reminder from some.
You still with us, Darren?
Yeah, sorry about that. The challenge is when you have substantial wash sales that may be tied to some positions that carried over into the next tax year. And that's a challenge because we're actually going to have to go back in that case and possibly rerun your entire transactions that took place in the prior year to make sure that none of those wash sales that are tied to any open positions aren't being missed, because some brokers may not be actually including that wash sale into your cost basis of what's being carried over. So anytime we take on a new client that had some open positions or had substantial wash sales, we're going to make the recommendation to you that let us go back and recalculate your gain and loss for the prior year inside of a tax software program that we use. And let's make sure that things are matching up to what your broker reported. Maybe the gain and loss wasn't quite right. Maybe we need to consider amending that. But we want to get you on the right page going forward. So if you did have some of these wash sales that were deferred, we don't want to make sure that we don't lose those from going from cash to market if they're embedded into the actual purchase price of that replacement. Wash sales are very complicated, and you need someone that truly understands that. And I've spoken with several CPAs across the U.S., and it's nothing against my colleagues. It's just not something that they deal with on an everyday basis. Most CPAs are putting that reliance on the actual 1099 that the broker's giving them, because the broker should be doing it correctly. But a lot of times when you get into wash sales, you need to speak to someone that deals in it day in and day out. And that's what we do. That's our specialty, and making sure that those wash sales are being accounted for. And then when you sign up for our trade accounting service, and that's part of it's a separate service, but it's embedded with our tax preparation service. We don't offer it separately. It's kind of a bundled package, if you would say. We're going to go in and we're going to look at that in detail. And that's more or less adding the value back to you as a client to make sure that we're trying to capture all of those wash sales that may be rolling over from one year to the next.
Well, let me ask, thank you, Darren. Adam, I know we see a lot of 1099Bs, a lot of tax reports. Brokers provide different types of annual tax reports. Are they adequate for filing tax returns? And Darren had already hinted about some of that.
Yes, some are. We have some situations where we can use possibly the annual report or some type of report that the broker generates or the client can download. So there are certain situations, and these are again case by case of whether or not we can use these or not. But yes, there are some out there to answer that question.
Now, should securities traders use trade accounting software, like the kind of software that Darren was talking about?
Yes, especially if they've got multiple accounts and we got wash sales across accounts, or if they've got even multiple accounts with mark-to-market, we may make it much easier to generate all these into one report that we can attach to the tax return. Of course, there's sometimes that maybe we don't need that software, but those situations are few and far between where maybe it's just a futures trader and they simply just get the 1099B. But the answer to that question is most of the time the answer is yes. The trade accounting software does help assist in preparing an attachment for the return and calculating the gain and loss.
And I know traders can get a retail license, or they can use our professional license service. Not everyone has to use our trade accounting service that uses us for tax compliance. Now, Adam, do some brokers use 475 reporting on the 1099B? If you tell them early in the year, hey, I'm a trader, I have 475, do they generate a 1099B or another type of tax report that gives us that type of reporting information we would need with mark-to-market and no wash sales?
Yes, if you let the broker know that that's what you use and that's mark-to-market, there are brokers that allow you to use that, and they report your 1099 using 475. We caution against doing this because they're going to continue to do that regardless. They're not going to change it back and forth for the years you qualify or don't. So if you qualify year one, then great, it works. Year two, if you don't qualify, then now you have to have some other accounting program to calculate your gain and loss with wash sales. And also the IRS now has a different report going to them versus what you're reporting. So it kind of muddies the water. So it's almost easier sometimes not to do that and then just use a separate trade accounting software to calculate your mark-to-market gain and loss.
Yeah, 1099B should really be prepared for the everyman. I don't like it that it's, first of all, a client doesn't elect 475 properly, but they still told the broker that they had it. It just leads to a lot of trouble. Now, in the case of, let's say, IB, where we work with a lot, I know we looked at some of their sample tax reports, and you were telling me, Adam, it's like one of those mark-to-market reports were ideal for use. What was that?
Yeah, since this is an IB webinar, they do have the IB annual activity statement that we normally request when we do our tax return for a client that uses IB. This is simply an annual report, and it shows the full year activity, and it literally has a little NAV section off to the side that kind of shows you all the activity that took place during the year, so you know what's taking place and what to look for. It has a section for where it marks to market the gain and loss for the year. So this report is very useful from IB for us when we do tax preparation for clients with IB accounts.
Great. But we work with all the various brokers, and they all have different types of tax reporting, and there's nuances with all of them. Some are great, some are not as great. We don't like to say names on a webinar like this. Right, Adam?
Oh, that's right. Yes. But yeah, I do, hats off for that report, and we like it. Other brokers, they have similar reports that we use. It's just like tax payers and everyone else. Everybody's got a different set of circumstances, and we use what we can from those brokers to prepare the returns correctly.
Trying to keep things simpler and easy for the client, but yet correct. I'm going to try to pick up the pace a little bit because we have a lot more content still to cover. The QBI deduction, that can get a little quirky. I don't want to get into this too much. There's the Form 8995 this year. Last year, there was a worksheet. That's for the simplified method. There's a more detailed method. If you are doing QBI, you may need to check in with us because it's a little bit of a quirky deduction. You want to make sure you're picking things up properly. So check out the new tax forms on that. Again, trading is a service business, so there are these thresholds. If you make too much money, you don't get any deduction at all. If you make in the phase-out range, you can get a deduction if you have a TTS S-Corp with wages because there's a wage limitation. So the Schedule C trader can also get a QBI deduction, but if they get into the phase-out range, they're not going to get it. So go back and check out these slides a little later on. I don't want to get too much in the weeds on QBI. On your K1 that comes from the partnership or the S-Corp, there's an other information section. That's where you see your 199A code, and then there's a detailed worksheet with the K1 that gives you the more details that you need. Is it 199A income? Is it 199A wages? Is it 199 property? So you can do all these various factors and have the information you need. And it might be an aggregate deduction. QBI is very complicated, folks. It's a tongue twister for a lot of accountants. It's very unique for traders, so check in with us on that. And you can still do it as a sole proprietor trader with 475. But again, if you're over the income threshold, you don't get the deduction. Now, as a continuation of what we were talking about before with the 1099B is, you don't want to just rely on a 1099B. Now, a lot of local accountants do because they don't want to depart. Darren, when you tell those local accountants that the wash sales are not correct because the IRS rules are different for taxpayers versus brokers, what's the answer you typically get?
Really? That's the answer I usually get. Really? Didn't know that. Most CPAs just really think that they can rely solely on the 1099B. And that is true if you only have one brokerage account, but you can't do that. I mean, honestly, guys, if you're with IB today and you're married and you have a brokerage account in your name, your spouse has a brokerage account in their name, and then you have a joint, married filing joint brokerage account. You got 3 accounts, they're all with IB, and you're trading similar instruments in all 3. You can't rely on just that 1099 to be accurate when it calculates wash sales. You can't, because IB or any brokerage firm is only required to calculate wash sales on what took place within that one account. That's it.
Yeah, so the broker is accurate based on the rules the IRS dictates to them. They're doing the right job. It's apples and oranges for what you need. Now also, Darren, that 1099 might say VXX is a security with tons of wash sales, and we say it's not a security because it's a prepaid forward contract. Or we might say they may list an option on an ETN that they say is security with wash sales, and we say no, it's not. It's a 1256 contract because it's a non-equity option. The exchanges are telling the brokers this is a security, this is a commodity, mostly because of securities law, not really tax law. Then the brokers are kind of following what's there dictated from the exchanges. Everything is either a security or it's a commodity, when there's a whole world of other things that it could be. And so you can't take it as the gospel. Now, Darren, we're always talking about what the IRS deals with. For the majority of taxpayers, they have a simple brokerage account. They don't have a lot of wash sales. They don't have all these exotic instruments. And the tax rules work. Why should the IRS make the rules for traders to work when they're really writing the law for investors?
Yeah, the majority of the time, no one is trading as active as what you that are attending this webinar, listen to this recording, are doing. So in general, most of the time, a wash sale is not going to be an issue for a general taxpayer. But for someone that's actively trading stocks or options on stocks, etc., you really can't rely solely on that 1099 if you have multiple accounts. So that's just a word of caution. If you're preparing your own return and you've got multiple accounts and trading similar instruments in each account, or also potentially trading inside of an IRA, another account, you need to consider combining all of your activity into one overall gain and loss to truly calculate wash sales. Otherwise, you may not have your gain or loss calculation correct.
And also this issue of identical securities, which are the rule for brokers. So symbol X, whereas the rule for taxpayers is substantially identical, which means the equity and the equity option. So if you trade, a lot of our clients trade options now and equities. Options have proliferated. So if we trade option December expiration, option X January expiration, they're substantially identical. They're substantially identical with the underlying instrument. So there's 2 ways that the 1099B can depart from the taxpayer rules: identical versus substantially identical, and one account versus across all your accounts. So these are the apples and oranges, and read about it in our content, and read that very important blog post, How to Avoid Taxes on Wash Sales. Remember, the 1099B is a very narrow view of wash sales, but for you, the taxpayer, they want a much expanded view. Why? Because if they didn't do that, you could easily defeat the IRS and game the system. You could sell it at one broker and buy it back at another and purposely do a wash sale loss, and the IRS doesn't want you to get away with it. So they have like a speeding ticket sign, only there are very few cops on the beat. We're one of them, and we do it correctly. And it could be in your interest to do it correctly, by the way. The trading at the other account could absorb the loss and do away with the wash sale. So what do you do about wash sales? You do all these strategies to avoid them. First, you know the rules, and then you learn how to break the chain. You have wash sales a whole year long. Sell everything on 12/29. Don't get back into a substantially identical position for 30 days. You broke the chain. You don't have a deferred wash sale from one year to the next. You don't trigger wash sales with your IRAs. You elect 475. You trade 1256 contracts. There's ways to avoid it. Read our content. I already explained the part from the 10, like on the VXX. That's a prepaid forward contract. It's not a security. whereas an ETN that's a debt instrument is a security. I talked about the option on the ETN. That can be 1256. Your foreign future could be 1256, but most aren't. So you got to look at what you're trading. Now, you might have cost basis adjustments. If you're trading commodity ETFs, those are like securities. You get a K1. The K1 says here's $10,000 at 1256 income. You got to adjust your cost basis reporting. Darren, are people still missing out on that adjustment and double counting the income and overpaying their taxes?
Our clients aren't, but I'm seeing it from review. In fact, I picked up a new client, I believe in December, that I saw that they had a lot of publicly traded partnership K1s, and I started asking him, I don't see these adjustments from when you sold it. And he said, I don't even know what you're talking about. So I said, well, give me the complete K1s with all the attachments. And I actually was able to show that individual where they basically over-reported their gain from selling that because they didn't account for everything they had to pick up on the K1. So we were able to file some amended returns to get that adjusted and get him some money back. So anytime you have these K1s coming from a publicly traded partnership, you want to make sure that you provide your accountant, whoever it is, with the entire K1, not just the first page of the K1. They need everything.
Most accountants would just work off the first page. They won't even know to make the cost basis adjustment.
That's right.
All right, so Darren, traders often get alarmed when they see massive wash sale loss amounts reported on a 1099-B, like $1 million disallowed wash sale loss for the year. Some of them freak out. How should they deal with it? I always point out it doesn't matter what it was for the year. It matters what it is at year end, what the deferral is at year end. And I think we talked about this already, the software and more. We have to, I guess, pick up the pace a little bit. Anything else to add with that?
No, I think we've already covered that, Bob. I suggest moving forward.
Yeah, I think Adam, you answered the next question when they can rely on it. We'll move forward. Common errors on tax return filings. We've covered a lot of these already as well. Some accountants say, oh, you're a business trader? Okay, let's use the Schedule C. So then they put the gains and losses on the Schedule C. They use the cost of goods sold for the cost of the purchase of securities. Getting ordinary loss treatment. They think they're doing the client a really good thing. They're botching the return and causing an automatic audit because the gains and losses have to go on other forms, and the IRS computers look for that. So you can't use ordinary loss treatment unless you elect 475. Darren told some war stories about that, and they're looking for it on Form 4797 Part 2. Darren talked about the transfer strategy. You got the red flag, the expenses on Schedule C. You need income for the home office. Why not do the transfer? Explain in the footnotes. It might help you with a state like New Jersey that doesn't allow a Schedule C loss. It unlocks 179 depreciation, the home office deduction. It looks a lot better. You explain it in the footnote. Darren, every once in a while we get a client that we see a return from the account. They put stuff on Schedule C, and then they had the client pay SE tax and then do a retirement plan deduction. And they can't do that. They don't have earned income. There is no SE tax unless they're a full-scale member of a commodities exchange trading futures on that exchange. That doesn't include the electronic corporate membership. So we see that they have excess contributions to retirement plans. What happens if they do that, Darren? What do they have to do?
We basically have to get that money back out of the plan because you were ineligible to contribute to it. So now the longer it sits there, the potential for penalties accruing keep going. So it's not something to ignore. It's something that needs to be addressed.
Okay, so again, trading is not earned income. So there's no self-employment tax. If you do a transfer to Schedule C, it's only enough to zero it out. You're not leaving a net income on Schedule C, so the IRS computers look for SE tax. Yet that Schedule C is an SEI deduction. It can offset your SEI, self-employment income SE tax, from your other Schedule C consulting business. These are all nuances, folks. A lot of local accountants get this all botched. And this is real clear in the law about these rules. Now there's also the net investment income tax. We fought the IRS on this one. Remember, we wanted to get 475 buckets picked up. We had a lot of work to do. Traders got really hurt on these rules until we fought to get great results for traders. Don't forget to deduct your trading expenses on this net investment tax if you're not deducting it for SE tax. But you can't deduct investment fees and expenses because they're not allowed on Schedule A. There are nuances here, folks. Darren covered the 1256 loss carryback election before. You come to us, hey, I lost 100,000 in 2019 in futures. I made money in futures in the past 3 years. Check the box on Form 6781 to do the loss carryback. Darren, should people use our firm for the loss carryback or do it on their own? Are there a lot of quirks, and if they do it wrong, is it delayed? Or what do you recommend?
I highly suggest having us doing it because we know what the IRS is looking for. And I mean, if you just leave one form out, they'll reject it and they'll basically kick it back. And then there's issues where states have, knowing what we know, there's issues with certain states like New York, for instance. New York has basically where they say they will only allow you to carry it back 2 years. Well, they have to follow the IRS rules because they don't have anything that says to the contrary. So even though we're filing a amended return for the third previous tax year, New York still has to accept that. And we know that because we've been working with New York, so we know how to explain that to them. So that's the value that we're adding back, is you're basically paying us for our knowledge and knowing that we're going to file this thing properly.
Now, Darren, that brings up a great point. We have traders in every state. They go right down the lines of state populations is our client base, right down the line. And there are so many nuances. State coupled to the IRS, unless they depart specifically with modifications, there's a lot of quirks with credits and deductions and a lot of quirks for traders. And we're on top of all that. And we have great software for states using the Lacert product. So I'm glad you brought up our state knowledge base. And I remember we used to have those NOL carryback issues with California froze them years ago, or had the limitation on the use. I don't know if I got that exactly right, but there's all sorts of quirks that come up. All right, next, errors on TTS entity tax returns. Adam, I may ask you to jump in here. So we set up S corps, a lot of S corps. Why? To create earned income, to unlock the health insurance and retirement plan deduction, because as we pointed out before, trading is not earned income, so traders can't do it. They need TTS and the S corp to do it. But they got to execute all this before year end, and we channel them all to you, Adam. So what were you doing in December with all our S corp clients, Adam? And if they didn't do it with you, it's a botch. What did they have to do?
Yeah, December, we worked mainly on trying to see what kind of payroll that they wanted to pay themselves to be able to contribute to the retirement plan, or even working with a payroll company to report their health insurance for the year on the W-2 so they could get the deduction that they needed for those.
Now, did you also do the accountable reimbursement plan for the home office and more?
No, yes. So especially for the clients that we help assist in forming, we provide them with a accountable reimbursement plan that they sign so they can then reimburse themselves for year end for this health insurance and the other items that they paid personally.
So if they don't do all this in December, they miss the boat.
That's right. It's things to get done before December. It's like many things with the tax law. You need to get it done in the year that it should take place. Sometimes you wait too long, it's too late.
So the S corp is a serious formal structure to use. We don't have the unreimbursed partnership expenses like with the partnership. Now, Darren, when you review tax returns for traders, whether it's in the office or new clients that come in, use other accounts or self-prepared, can you name any other common errors, or do you think we covered really most of them already?
Man, we have greatly covered most of the overall issues. I mean, some of the issue with claiming using business income as self-employed income for retirement contribution, that's a big no-no, but it still happens. A lot of people seem to think that if you file as a trader, okay, you got to file a Schedule C. So on top of Schedule C, the first section, it talks about what's your sales proceeds and your costs. So some people put their sales on the Schedule C. Well, that's incorrect. I mean, if you look at IRS publication 550, it basically really clearly says how to report as a trader. And you don't report any of your sales or your costs on that. A lot of times I see traders doubling up on their commissions. They think, okay, well, I qualify as a trader, I'm going to deduct my commissions on Schedule C. No, your commissions are more likely than not always going to be within your purchases or your buys with your purchases and your sales with the brokerage firm. That's not a separate expense. And just, missing out on not reporting the home office deductions, things like that. There's not just working with a CPA or trying to prepare this thing yourself. It's not, the business of trading is not something that an everyday CPA firm deals with. And working with someone that this is what they do, and that's what our firm does. I mean, we do this day in and day out. In fact, as we said, if you're looking to come on as a new client, you have to qualify as a trader before we'll take you on a client. That just shows you that this is what we're working with. We work with traders. So having that peace of mind that you're coming to a firm, that's what they do day in and day out. That's what we're offering you, is if you want to work with us to prepare your tax return.
Now, Darren, we also have a trader tax return review service new this year. We kind of did it informally in prior years, where someone may try to do the return on their own and then have 1 hour with you or Adam to look it over. It's not a look at the source docs. Do you think this is going to be popular this year too?
I believe it will. And basically what this is, if you've got an existing CPA and you've got a relationship with them, and maybe you have some other activities going on, maybe your spouse has something and you just don't want to change from your existing CPA, I can understand that and I can respect that. I would hope our clients would not necessarily want to leave us as well. So, but you're filing as a trader and you just want more or less a peace of mind that this individual is preparing the return properly, as if our firm was preparing the trader portion. So we're going to ask you to provide us with a copy of the return. I may ask you for some of the source documentation, but it's more or less just looking over and see if the presentation looks proper to where nothing's going to stand out. And the same as Adam can do with an entity return. Now, when we get into, this is not something where you can say, I want you guys to prepare the trading portion of my return only. We don't do that. We either do the entire tax return or none of the return. So this service that we're offering that Bob's showing you on the page right now is strictly, you have self-prepared your return or another CPA and you want us to kind of review it and see if it looks proper from more or less a top level standpoint, a presentation standpoint for someone as a trader. If you need our help solely preparing the return from start to finish, that's signing up for our preparation service.
And then we had that accounting service in conjunction with that as well, if they're interested in that. Now, Adam, I think you already answered this question. Some of the errors you see on the entity return where they didn't do the payroll or they missed certain things. Any other errors that you see on the entity returns, Adam?
Nothing more than what Darren said. I mean, the public traded partnerships, things like that, they kind of go in the same line of the errors you're going to see on the individual return. Sometimes just actually reporting gains and losses in the wrong place, if it's Forex potentially, or some other items like that. But mainly the same errors we see with our Schedule C clients we see on the entity returns.
Now, I know you always tell me, Adam, people have to flush out that margin interest on different pages of the 1089B. I think we got to handle rebates. There are other issues that come up. Now, Darren, you were reminding me this morning as we were prepping the webinar that our internal deadlines are coming up. I mean, tax season is here. It's time to act. A lot of clients, if they're not ready, are going to need to file an automatic extension to get 6 months more time. But they got to pay the money they owe at the same time. They got to make the elections. So we want them to get a handle on the 1099Bs, see how much they owe. So the tax return is due April 15th. They can file an extension. The partnership or S-Corp returns are due March 15th. This way you have more time to issue those K-1s. A lot of securities traders are struggling with the wash sales. They don't have all their handle on all the expenses. They need more time. So we say file an extension. It's a simple one-page document. It avoids the late filing penalty. You should pay what you owe, otherwise the late payment penalty. Bottom line is you got to get that filing done. Otherwise, those late filing penalties are outrageously high. We have some blog posts about it. What do you want to tell as a parting point, Darren, to our clients and future clients about extensions and working with us and all that?
Well, you can go to our firm website and look at our professionals, and that is our group of professionals. And I say that as we don't hire temporary CPAs to come in and help with the influx of tax season, or we don't hire interns. When you engage with our firm, you're going to be working with the group of professionals that's listed on our website, and Bob's actually showing you these individuals right now. And because of that, we have these set professionals with a set available number of hours that they're going to work during tax season. So because of that, we're only allowed to take on so many new clients. And that's one of the reasons why we have the free 15-minute new client evaluation, is making sure that we're going to be a good fit for you and vice versa. So with that being said, we have internal deadlines for our clients, because we can't let all of our clients just wait until April 1st to provide us all their information and then want to file by April 15th. We just don't have the manpower to be able to handle that. So we give all of our clients an internal deadline. So if you're wanting to file your actual individual tax return for 2019 by April 15th, we have to have basically your information in the door to us by the first week in March. And then that gives us enough time to make sure that we're giving to you the time that we need to give to prepare that return and not rushing. And that's the reason going into extensions. I mean, we highly recommend extensions, because there is so much compressed time now between when you guys actually get your 1099s. I mean, more likely you just got them this week. And so if you just got them this week, you basically have less than 2 months if you're wanting to file by April 15th. Well, that's not enough time to truly go through and make sure that everything is correct. Sometimes corrected 1099s are issued. You don't want to rush that process. File a 6-month extension. It doesn't cost you any more to file an extension. It's not going to cost you much more of anything. I mean, we can work up an extension, and shows, main thing is what we're doing with the extension is seeing, do you have to pay any tax by April 15th? Because the extension is not an extension to pay, it's an extension to file. So if we're seeing that you're already in a refund position, where your extension is pretty easy, we file the extension, and then we basically work then on your tax return in the slower times of the year, the summer months. We're not going to wait until October 15th to get your return done. We're going to steadily get to it in the summer months. And then if you actually owe, then we need to look at your return in a little bit more detail to make sure that you pay in enough so that you don't incur any late payment penalties. And what we do, our extension process, is we want to be as conservative as possible when we calculate your extension. So if there's some expenses that you haven't gathered up when we're doing the extension calculation, we're probably not going to include those into seeing how much your tax liability is. And that way, potentially, when you file your extension, you're overpaid. Now, when we file your tax return, we're going to be as aggressive as we possibly can and take the expenses that are due to you to take. And if you paid too much in when you filed your extension, well, you have two options. At that point, you're overpaid, so you have the option of having that refunded to you, or if you need to make estimated tax payments, that overpayment that you made with your extension can be considered part of your first quarter tax payment for the next tax year. The key is if you are going to have to owe, is make sure you pay that in, because if you don't, even if you file an extension, you're going to get charged with a late payment penalty. Now, you can file an extension, and that will help avoid what's called late filing penalties. But if you file an extension and you ultimately owe tax for 2019 and you did not pay that by April 15th, you are going to incur a late payment penalty. So, and the late payment penalty is less than what the late filing penalty is. So even if you owe and you can't pay right now, please file an extension, because that late filing penalty can be very substantial.
Well, Darren, sophisticated and wealthy taxpayers always file the last minute, right before the extended deadline. They always have. They frame the big picture for April 15th, get the payment in, get the filing in, but then have the whole summer to work it out. You know, the early bird gets the worm, but you're the worm and the IRS is the bird. You file really early, you're the one who gets selected for audit. So even if you're getting a refund, try to always be patient with the IRS. The more anxious you are, the more they think that you're playing around with the numbers. Now, if someone is entitled to a big refund, yeah, we're going to work with them to try to file early, but that's not everybody. A lot of people really appreciate the extra time to turn in the homework, to turn in the term paper. Adam, what about the extensions for the entities?
Yeah, even tighter deadline for the entities. The extension is due March 16th. This year it's coming up. So you've got less than a month to get these done. You just got your 1099s. And who's to say these 1099s won't get corrected or amended next week or 2 weeks or right after we file, and then we have to amend the return? It's not worth that headache. It's a lot easier for an entity to file an extension. It's simply one form for the IRS. Literally nothing you have to calculate on that portion. Now, for some states, yeah, there may be some taxes due or some franchise fees, or so to speak, that have to be filed with the extension. But it's really easy for an entity. I almost would recommend it, even if you're going to file on time, just to go ahead and to be safe, have it in there, because if you still file, it's okay. But just go ahead and get that done, because there is a late penalty on entities for not filing on time, and that can add up depending on how many members or partners are in the entity.
Now, these blog posts that I brought up are from last year's versions. That's why it said March 15th. That was for 2018 returns. I'll have an update on this soon for this year, but it's pretty much the same content, so I referred to it. So, folks, I think that brings us towards the end. We have some closing remarks we kind of made already. Darren, you've been answering questions on the board throughout the session. Are there any really highlighted ones that you want to bring up the question and the answer for?
Yeah, I have done my best to address the questions, and I apologize I haven't been able to get to everybody's, but I think I've got most of them. The question that came up multiple times, Bob, and I know we've already addressed it, but maybe you or Adam could reiterate it one more time, is if you elect if you're trading stocks and also futures, can you elect mark to market for stocks and not futures? And can you do that if they're basically, if you're like with IB and you're trading stocks and futures in the same brokerage account? Is that allowed?
Yes. Yes, it is. Whether it's one account or multiple accounts, there is segregation anyway, but even though it's one account. But yes, you can elect for securities only. And sometimes clients come to us, they work with other accountants, they make the election, but they don't specify whether it's securities only. We prefer that they do. But if they're only trading securities when they elect it, it's kind of implicit it was for securities, but you do leave a little door open to the IRS to challenge. So we like you to be specific.
Another question I saw gets involved with entities, and more or less a synopsis of all the questions is, do you have to have an entity? When do you need an entity? And do you guys recommend C Corps? So Bob,
right,
since you do most of the entity work or the consultation, I will leave that to you. And then Adam, since you work mostly with our entity clients, if you guys want to piggyback on that one.
Well, here you are today. You don't have an entity, but you do have trader tax status January through today. So you've been deducting your business expenses year to date on a Schedule C. You plan to do that because you have TTS and you plan to have it for the rest of the year. So for your business expenses, you don't need the entity. You're good to go with the Schedule C. Second benefit of TTS 475, the election is due by April 15th as a sole proprietor. It's before April 15th. You can do that as a sole proprietor. You're good to go on that too. Next question, what about your health insurance? If you're covered in your spouse's job or your own day job, you don't need a health insurance deduction, so you don't need an S Corp for that. If you have a job and you're doing the employer 401k, you're happy with that, the elective deferral, you don't need a profit sharing plan on top of that, you don't need the S Corp. Well, you say to me, Bob, I'm a full-time trader. I don't have health insurance with a spouse or another job on my own. I want that health insurance deduction. It's $1,000 a month. I can't do it as a sole proprietor trader. For that, you need the S Corp. For the period of the year you have the S Corp, you can deduct it, so you won't get the deduction for January and February because the entity will be up and running by March. March 1st, it takes about a week normally. And lastly, if you want that high deductible profit sharing plan deduction and elective deferral of the solo 401k, could be up to $63,500 as age 50 or older, you need the TTS S Corp for that. We don't like trading in a C Corp because it's double taxation. The only time you'd use a C Corp management company is if maybe it works out for you in your given state. Usually you don't need a management company, a dual entity scheme. You only need one entity. So learn more about entities on our website. We have separate webinars on that. Adam, did you want to add to that?
I think you covered most of it. I know we're running short on time, but it it answered a lot of the questions I had coming through. I answered several of the entity questions. A lot of them was, can I have a trader status individually and then the entity? Of course, yes, you can have part year individual, and then once you form the entity, you could close that account and have the entity qualify as a trader for the remainder of the year.
Good. Well, Darren, any other questions to bring up? Otherwise, we can wrap things up.
There was a lot of questions, just what does it take to qualify as a trader? And Bob, you've got it on the screen right now, and I'll refer everybody to that. There's a recent blog that Bob's written, how to qualify for substantial trading savings as a trader. That's, if you go to our website and look straight at our blog, right on the face of our website, you'll see that blog. And inside of that blog, it basically lists the qualifications, which we call it our golden rules for qualifying as a trader. And that's really where you need to start. All of your conversations, discussions, if you want to have a consultation with us to discuss trader tax status, start here with this blog and then see where you fall into this. And if you are a little questionable, I mean, we can address that, but this is really the starting point to see if you're going to have enough trading activity to qualify as a trader. I appreciate the opportunity Interactive Brokers has provided to us today to do this presentation. I hope you found it valuable and useful. And if we can help you and you qualify as a trader, please reach out to us. If you need a consultation, we can do that. If you need tax preparation, let us know. We'll see if we can still work with you for the tax return or at least the extensions. Or if you're preparing your return, another CPA prepares it and you just want kind of a top level review, then take advantage of our new review session that we offer, and then we'll see if we can help you from that aspect also.
Well, great. Darren, Adam, thank you so much for joining me today. It went really well. Cynthia, back to you, and thanks so much to IB.
Well, thank you, Bob, as well as everyone from GNM or Green Neuschwander and Manning LLC. But before we do end up today, I'd like to grab the controls for just a moment so that we can go ahead and locate the information, because I do see that it was our tax forms have just been added to our website. How do you find them? Well, from the Interactive Brokers website, notice here, now you may have a different look. But if you go to the About Us information and into news, you'll find that we just sent out last week, excuse me, a communique that includes tax form availability. Now you can go in, simply click through this link and locate the information. I have it already pulled up here that appears under that link, showing you the tax form availability. Simply click here to start your planning and you'll see the tax forms that were just released. These are available and you can download them directly from our website. Also, do want to point out that through from our website as well, if you can access through any of our portals. Notice here I'm going to go into our client portal, which does include the reports that are available to you as an interactive broker client. Now, these reports are available, and you can go into the report section here by simply clicking through that link. By the way, you'll also find reports are available using the 3 lines that appear up on top. Go into the reports here, and it will take you to the same page where you can access the tax information that's available for your account. Now, this happens to be a test account, so I don't have any information here, but do be aware that you can actually view tax information for the 5 previous years. So I did want to point that out. And with that, I want to thank all of you for participating with us here this afternoon. And special thanks to Adam Manning and Darren Neuschwander for answering all of those questions, and to Robert Green for today's presentation. We have been recording today's session, and each of you will get a direct link later on this afternoon to the recording, as well as the same slides that Robert's been using for today's event. So with that, thank you all so much for your participation, and thanks to Green, Neuschwander, and Manning for answering all of those questions. By the way, do check out the Interactive Broker site. You'll find that information will be available. I'm simply going to take us back to the home page today. You can find today's webinar and any previous webinars. You be able to access underneath the education menu. Go into the webinar section and you'll find that you can view any of our upcoming, sign up for upcoming events, or go into the recorded webinars by simply clicking through here. We'll have today's presentation loaded up for later on today. So do check that out, as well as your inbox for follow-up messages that will go out later on this afternoon. So with that, we are going to conclude our session here this afternoon. You can all exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and thanks so much for participating.